Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal studios. I'm Prashant. Sonia is out of action. We have Surabhi here over the next 2.5 hours. Nigel is joining in as always as well. Guys, hi. Good morning.
Good morning, Prashant. Good morning, Nigel. So today it is D-Day. I don't know what to call it. Finally, we're all set up, braced up for this all-important event that'll hit us, what's on 10:30 our time, I think? Around that time.
Yeah. When you said D-Day, Surabhi, I had all those images of troops landing on the beach in Normandy.
Well, the troops have landed, right? From the ECB to the Federal Reserve to the US Treasury. The troops are in the house.
Besides the big queue that we'll watch out overnight, domestically, and since we are in the state of Maharashtra, wishing all our viewers out there happy Gudi Padwa. So wishing all our viewers out there. Maybe volumes will be a little bit lower because domestic participation could be a little bit lower, but it's a good day nonetheless.
Oh, absolutely. Auspicious day. Money markets are shut.
Yes.
So it's ruby markets
holiday.
are not trading. So I think that's something to watch out for. But overnight, we have positive cues, right? I think that's what we begin the day with. And let's just kind of rewind back and tell you what's important as we begin another session. So markets overnight had gained for the second day in a row. And the Fed decision is later tonight. So you can say that the rally was into the Fed decision. Could you kind of say, well, this is in anticipation of what the Fed will do? Unlikely, because there's still a fair bit of confusion and division of what markets are expecting. So the changes are up on your screen. By the way, the S&P with a close above 4,000 is once again conquered the 200-day moving average once again. But, the point is the market has been so flat for so long in the U.S. That even some of these longer-term moving averages are very close by. Doesn't take very much in terms of a move for the market to jump above or below these averages. Now, there were reports which suggested that the regulators in the U.S. are becoming more comfortable to temporarily backstopping all deposits. We don't have anything sort of in terms of a confirmation, but more and more news reports indicate that that's something which they are open to doing. Data came in hot. And this is the conundrum which the Fed will face. The U.S. February existing home sales data was the strongest we've seen since July of 2020. Now, you can say that this is because, mortgage rates fell a little bit towards the end of last year. So this shows up with a lag in terms of more home purchases, etc. But it is what it is, and data is strong. Housing data is strong. Yields market responded quite aggressively. Up on your screen, the 2-year was up 19 basis points, the 5-year, the 10-year, all jumping back up. Now, we can get into the debate, but I think broadly what is expected is that the Fed will deliver a 25 basis point hike. Perhaps it will be accompanied by statements that say that we stand by to maintain financial stability, etc. as well. So you can kind of call it a dovish 25 basis point hike, but a hike nevertheless. By the way, if you want to look at what the Fed has done when they have been in a rate hiking campaign and there is financial stress which emerges, one should also keep in mind that if you compare the current period to previous episodes, inflation is high, unemployment is low compared to previous financial turmoil. So that's the reason why I think it's prudent to expect at least a 25 basis point hike. Now, coming to the market here, the Nifty saw a good rally. The Bank Nifty actually did even better. Banks did even better, private and public both. The Nifty needs to cross 17,180 for bulls to feel more confident. We're not very far away. It's about 70-80 points. That's the same 17,200 level. It's a downward sloping line. So 17,180 is that level which the bulls need to cross, which Nifty needs to cross above and close above for some more confidence to come back. That's basically a short-term reversal signal. The low, which is of 16,828, should not be breached on the downside for the Nifty. On the Bank Nifty, the 20-day moving average comes in pretty close by at 40,209. The 200, of course, we took out on the Bank Nifty, and 40,209 is a 20-day moving average. Again, a short-term reversal signal from being bearish to slightly bullish. And yesterday's low on the Bank Nifty, which was 38,941, is an important downside level, which should be protected if you want the market to stay more buoyant and stay more kind of resilient. Having said all of this, remember, we get the Fed decision only after market hours. We get it during US market time, and we will react to it tomorrow morning. So given that, if you are sort of not really itching to take a trade, and if you're trading very, very short term, perhaps it's just better to wait it out And I think the market will kind of reflect that in terms of trade today, as the SGX is also reflecting. Come back tomorrow, see what the Fed has done, what they've said more importantly, and then maybe take a position. If you're trading very, very short term, if you've got, of course, time on your side, as we've been saying, I mean, these are good levels after the correction that we've seen. Surabhi, hi.
Hi, Prashant. Well, absolutely. Actually, the SGX is far more modest than a lot of the other markets in Asia right now. For instance, Hong Kong and some of the other, even mainland Chinese markets are ripping away 2.5% higher. Yeah. So, I mean, in that context, the SGX is showing a very modest gain, at least for the time being. So let's see how that plays out. That's our neighborhood, which is looking actually even better. Prashant, just to take off from that point that you made about the perception that there's a permanent backstop, like a US government backstop now. So I was going through some of the commentary that appeared last night. And Janet Yellen was speaking at none other than the American Bankers Association. So therefore, you know that those remarks are obviously very, very carefully prepared and then delivered. And that's what she said. I thought I would just put that up for our viewers. She says our intervention was necessary to protect the broader U.S. banking system, and similar actions would be warranted if smaller institutions suffer deposit runs that pose the risk of contagion. So when the regulator or when the government comes out and tells you we are there, the market listens, and I think that's what was playing out last night. It all really showed up in the way European bank stocks also moved higher. There were two pieces that were bothering the market. One, what's happening with the $17 billion bond loss on Credit Suisse 81 bonds. But yesterday, at least, the market seemed to be giving an indication that it's in a mood to move on. And that's what those stock prices indicated, including, by the way, Credit Suisse, which was up about 7%. Onto the Fed, Prashant has covered a lot of the ground there. Just want to say the probability, you keep looking at the Fed Watch tool, right? And the probability, at least as of about half an hour back, was 86% saying we'll get that 25 basis points rate hike. So let's see how that plays out. And markets across, I mean, whichever asset class you're looking at, equities, if you're looking at the dollar, which has been, moving back, moving a little higher, yields Prashant alluded to. Look at oil, there was a bit of an upbid on oil, gold was cooling down. So whichever market you're looking at, markets are positioned for this 25 basis points rate hike with dovish commentary, pretty much similar to what the ECB did, right? ECB delivered 50 basis points, but said, don't worry, we're there to step in whenever needed. And the market's expecting exactly the same from the US Federal Reserve. And the Fed rarely disappoints. And markets have cooled down as well as we're getting into the Fed meeting. So perhaps it's a lot better than where we were about 48 hours back. In India, of course, the volatility is ebbing. The VIX was down about 5.5%, 6% yesterday. Even the CBOE VIX, I mean, globally speaking, US markets, volatility is coming down. That would be good news for the Federal Reserve as well. FIIs have been net sellers. DIIs are offsetting that. The numbers are there for your screen. But this data is very skewed. We have so many blocks on a daily basis that X of blocks, what's happening in the market, a little difficult to gauge. But those are the numbers. Lots of DII buying even yesterday. Nigel, I think I look out for two questions, really. One, whether banks can build on the recovery. And two, whether Reliance can show more metal, right? Because these were the twin engines that were really firing up for the market. But I guess given the cues, I think we're probably set at least for a start on the upside.
Well, that's right. The SGX is suggesting a bit of a pullback to kickstart trade. And yesterday, in fact, we had a very, very good session because the Nifty Bank had conquered the 200 DMA, which was good news because at the start of the week, we started at the 200 DMA and it gave that away. So good to see that we pulled back yesterday. And there were signs of short covering, particularly on the Nifty Bank. Now, the problem is the Nifty is getting to that congestion zone, 17,150 to around 17,250. The bulls, they like to look at the 20 DMA, both on the Nifty and the Nifty Bank. But besides the Nifty Bank and Reliance Industries, I think today there'll be some support that could probably come in from the Nifty IT index. And I say that because overnight you have the Nasdaq that outperformed. And we have been seeing there is some correlation that plays out there. So the IT index today could come back. Yesterday it was the big drag. If it wasn't for the IT index yesterday, we would have probably been closer to around the 17,200 odd. What do the FIs do in the F&O market? Well, yesterday they gave themselves a break. They've been adding shorts non-stop, almost on a day-to-day basis. Yesterday they didn't do much, both on the short and the long side. The short positioning, as we've been seeing, is very, very aggressively net short, more than 90% on the short side. The options data was encouraging. They bought more calls than puts. They bought close to around 3 calls for every 1 put. And the biggest positive for me, which is telling you that there could be a bit of a near-term base, provided we don't get any fresh global negative news coming in there. They wrote puts. More than 80,000 puts were written in yesterday's trading session. And a couple of strikes I want to highlight. 17,000 put, 17,100 put on the Nifty. Close to around 70 lakh shares getting added out there. So that's some writing that we've seen out there. And on the Nifty Bank, you had a lot of writing coming in at around the 39,500 put. The premium out there is around 100 rupees odd, which brings us to the levels. Very, very important. Since they're writing that particular put, well, on the Nifty bank, the support comes in at around the 39,400 odd. You deduct 100 rupees from around the 39,500 put. On the Nifty, well, you have 16,950 odd, so your Nifty could pull back close to 100%. But it seems if you don't get some, big negative cues coming in there, and if you get the 25 basis points odd, maybe the Nifty can move a little bit higher. Ideal situation will be the 20 DMA both on the Nifty and the Nifty Bank. SGX Nifty suggesting a green start. Maybe a day of consolidation would not be so bad, and the Nifty IT index could do pretty well today.
Things should look better, Nigel. We were discussing this on closing, I think last Tuesday or Wednesday, and at that point it was looking really tumultuous.
Yeah.
And we were saying that just maybe. First of all, this is not 2008, 2000. It's almost as if people who've seen 2007, 2008 want a repeat of that, just to kind of relive it because they probably...
I don't think so, Prashant.
No, it felt like that,
really...
right? And we were saying how maybe by the end of this week, right, things should look different. I mean,
and
next week should
look... talking yields. You're saying that yields, rates, inflation...
More normal kind of market, worrying about inflation and not worrying about a bank going under. Although this Credit Suisse and UBS thing perhaps added one more sort of bank into the mix, which was unexpected.
Yeah.
But the US thing has settled down. It's looking much better, I would say.
I was looking at a Bernstein report yesterday, and they listed out 5 key reasons why, in fact, 2023 is not 2028. I'll tell you why. 2008. The few reasons they said, the housing sector is in far better shape. The agility that the central banks have reacted have been far better. You didn't have that big gap. A couple of days, everyone came together and you saw things getting sorted out. And the data points as well are fairly good as well.
I'll tell you a simple reason. No one knew what subprime was in 2007,
Exactly.
2008.
Here, there's a tape
here
to
it is it's a liquidity issue. It's not a solvency issue. In 2008, it was a solvency issue, which I think was the big difference. But
it's different.
It's different.
It is
different and it's completely...
As of now, and let's just hope it remains that way. That
I think we can say that it's different.
Okay.
All right, we'll get on with this now. Let's tell you what's lined up on the first half of the show. We'll get you updates from markets across the globe. Rajat Bhattacharya of Standard Chartered Bank will join us to discuss the global trade setup. Our research team will bring you CNBC-TV18's list of top 10 stocks for the day. At about 8:30 this morning, we'll do a fundamental stock analysis with Devin Choksi of KR Choksi Securities.
And on equities, let's get you the call coming in from Vikas Jain of CLSA, who says sentiment as per their proprietary India Bull Bear Index is 91% bearish ahead of the Fed meeting. He says barring the huge declines of 2008 and 2020, they have seen such bearishness 10 times in the last 15 years, and 9 of them were good entry points. He expects the Fed to raise market confidence and appear less hawkish, which may drive a sharp rally. To raise bets ahead of the event, he says they add Reliance, Hindalco and Indocin to their portfolio, but exit Infosys and NTPC.
Well, the money market is shut today, so we have no money market calls. That's on account of Gudi Padwa, so have a good day, all of you. Well, but we have plenty of stocks, actually, that we'll be tracking for you today, and we'll get to that in just a bit in our special Top 10 segment. We're looking at a whole host of stocks, starting with Hindustan Zinc, Vedanta, Tata Motors, Bandhan Bank, Indian Oil, Zydus Life Sciences, Tata Power, and HG Infra. All the stocks on the back of positive news flow. On the flip side, you have Devyani International and Greenlam. Large trades taking place out there, so maybe some negative news flow on both of them.
Okay, well, let's get Rajat Bhattacharya into the conversation, Senior Investment Strategist at Standard Chartered. Thanks very much, Rajat, for joining in. Good to have you with us here. Is there any other possibility, apart from a 25 basis point hike later today?
Hi, Prashant. Morning. I don't see, I see very little possibility of any change from that. Why? Because the Yellen and the Powell Fed over the last few years have never surprised the markets. I mean, this is what we looked at very closely. And if you go back to what the market was pricing 2 days before Fed decision, and what the Fed delivered, it's the same line. You can't even tell the difference between the two. So no surprises are expected based on what they delivered over the last several years.
Okay, Rajat, hi, good morning. So I think the market positioning right now is everyone's poised for a pretty sharp recovery because they're expecting the Fed to be fairly benign, even if they deliver 25 basis points. And then the positioning seems to indicate that it's up from there. Would you concur? Do you see it playing out that way?
Now, this is where the forward guidance comes in, right, for what Powell says. And I agree with your point that they will try to reassure markets, and they have done a lot. If you see what the central banks have done in Europe and in the US, it's dramatic. The way they came in to backstop depositors yesterday, Yellen almost confirmed that they are standing by to guarantee all deposits. Now, interestingly, I must add here is that a lot of what we've seen in Europe and US is playing from the playbook of Indian regulators. What Indian regulators did in the past by banking failures, we've seen 4 in the last 2 decades, is exactly that. They went in with the support, they reassured depositors. Depositors were not harmed. The shareholders were, of course, written off. And this was not the case. Mind you, these are important changes happening in US and European regulatory industries. We have heard time and again from Europe and US that, you have the moral hazard. But this time, I think they've learned a few things. To your point about learning from past mistakes, they've learned from the global financial crisis. And to some extent, you're taking out the playbook of some of the Asian regulators here and guaranteeing the deposits. So liquidity crisis that we saw is being eased significantly. In fact, you saw last week, in recent days, the US banks have availed of the facility so much that they've availed of that facility to the highest extent since the global financial crisis. So they've gone in and got themselves as much liquidity as they need. So that's a big change that is happening. So going back to your question, we'll need to see what Powell says any more to that. There are challenges. The commercial real estate market in the US is a big risk, and the small banks are heavily exposed to the commercial real estate. So that's one big risk we need to watch.
All right. Hi, Rajat. Good morning. What about the approach to the Indian markets? Last time we chatted, you were talking about it's a good time to buy bonds here in India. What is the asset allocation strategy out here and the approach to the Indian equities as well?
Yes, Nigel, bonds will be a favorite this year. Where the interest rates are, where RBI is in its rate hiking cycle, bonds will be favorite. But equities have drawn down a bit. If there is a recession, and we see increased chances of a recession in the US and Europe after what has happened, I can tell you a few more indicators that we've seen on that, then there is further downside to global equity markets, and India will not be unfazed from that. So why we believe that the chances of a recession, global US and Europe recession has come forward is a few things we're seeing. US money supply is starting to contract. We already had the leading indicators pointing to a recession, but of late we've seen the bank lending standards shoot up. If you measure financial conditions based on actual conditions on the ground, including lending standards, money supply, credit spreads, and together, it's a big, sharp, tightening of financial conditions. So all of that has changed. In the job market, which was the one which was holding up the US economy so far, the leading indicators of the job market, such as temporary help services, those are the early indicators. We know the unemployment rate is a lagging indicator, but temporary help services, companies stop hiring temporary workers the first thing when they see signs of trouble. That has started to decline. And then you have the first year-on-year rise in initial jobless claims. Initial jobless claims have risen 4% almost year-on-year. You wouldn't see that when you see the long-term chart, but year-on-year it started to rise. Those are the first initial signs. The job market is also cracking, and we know that in the industries such as tech and finance, there's been a heavy shakeout there.
I take your point, Rajat, and another piece of data caught my eye, and that's the US housing market. February this year has been the first year-on-year decline in house prices, and I think over a decade. And that really stayed with me. Now, that's what I was telling Prashant earlier. Let's just hope that it all remains good. It doesn't go south from here. But very quickly, your view on India and how would you approach this market? Anything you like here?
Yeah, we would be pretty defensive in India. Large caps, the defensive sectors. That's the way to go. Long term, as I've kept repeating in this forum and elsewhere, is that in India, the long term story is secure, right? But because everything that you see going around here, it's almost like India is a class apart in that sense. You have the growth story going well. You have the EPS story going well. India is a defensive market. India is a domestic, inward, domestic-driven market. So even if there are problems in US and Europe, India is a safe harbor. If you ask me, there are issues with valuation still, and which is why we prefer within Asia places like China and elsewhere. But the long-term investor story still remains intact for India. So, I wouldn't buy necessarily equities here. Bonds are still going to be the favorite over equities. But, another maybe, 5-10% drop, and we start averaging from there in India.
Got that, Rajat. Thanks very much for the updates there. We look forward to chatting with you again soon. That's, of course, the outlook coming in from Stan C. Prashad, I didn't want to say it, but then with Rajat mentioning it, I put it out. I chose not to talk about the negative, but it was a statistic. I mean, the decline year on year in the housing, this is overall housing prices in the US.
Yeah.
It's only a 0.2% decline, February 23 over the previous year, 22. But it is the first decline in a decade. And you're right, a lot of us are colored by 2000, 2008, 2007, 8. Anything happens on housing, suddenly you sit up and take notice.
I'll tell you, people who started their career in 2000, I always say 2006, 2007, they saw very little of the bull market and they saw all of the downside, right? And how you start, kind of affects pretty much, affects you for a long time, right? Because if the shock is so large as the global financial crisis, you kind of are always looking over your shoulder saying, well, when is the next one hitting us? But all right, enough of the history lesson. Let's quickly take a quick break here. Our list of top stocks to watch is lined up. Our team will be joining in with a quick view on things, the stocks which will move up and down in just a bit.
Welcome back. There's green on the screen. Now let's talk about stocks and the list that you need to watch out for. So as always, our team is standing by to take you through the CNBC list of top stocks to watch this morning. Guys, thanks for joining in. Good morning to all of you. Nigel, I'll start with you. The story always is very interesting when you're talking Hindustan Zinc or Vedanta, right? So dividend coming through.
Well, that's right. Surbhi, I recall when that Vedanta Resources, there was that fear that they'll default on the bonds. I told you that there were three options, and one of the three I mentioned was that they'll just simply go out there and give a huge dividend from Hindustan Zinc, which flows to Vedanta and then flows to Vedanta Resources, and the case is solved in the near term itself. That seems to have played out as well, because Hindustan Zinc has declared the fourth dividend, close to around 26 rupees. For this year, that's only for FY23, the dividend amounts to close to around 75 rupees and 50 paise. So massive payout. Focusing on this 26 rupees itself, the total payout will be close to around 11,000 crores odd. That would mean that all the cash in the book on Hindustan Zinc's books as of the past quarter, which was around 11,000 crores, that's the net cash in the books. All of that has been paid out. So future dividends now will be interesting to see whether they can generate enough cash to pay out, because till now they were paying out all the cash from what they already had. Now, in fact, all the cash is turned out, and maybe they'll have to turn net debt as well. So let's see how that plays out. Out of this 11,000 crores, Vedanta Limited, that's a listed entity, it gets bulk of it, 7,000 crores odd. The street will be waiting by for them to pass it through. So just going by that equation, Vedanta Limited, if they have to pass on all the dividend that they receive through, it'll amount to around 19 rupees. Vedanta Resources will get a good amount of money, so then they can, fulfill their debt obligation. And Government of India gets close to around 3,300 crores. So expecting a green tick on both these two stocks, Hindustan Zinc, because they're giving the dividend, and Vedanta Limited, because they're receiving most of that dividend.
All right, Nigel, thanks very much. That's comprehensive. This is one of the stocks to watch today. Now, Tata Motors is in focus. Rima is here to tell us why. Rima, hi, morning.
Hi, good morning. So Tata Motors has announced that they will be increasing the prices for their commercial vehicles fleet for up to 5% or approximately 5% starting 1st April 2023. And this is in order to pass on costs associated with BS6 emission norms. So watch out for Tata Motors in trade today. Back to you.
All right, got that. Thank you, Rima. On to Abhishek. Abhishek, why are you watching out for Bandhan Bank?
because stress has reduced in the balance sheet as the board has approved a sell-off of about 2,600 odd crores of return of portfolio, which is more than 28% of the return of portfolio that they have done in the last few quarters, and about 2,316 crores, which forms a little more than 33% of the gross NPAs to ARC. So bank has received binding bid of 369 crore for the return of portfolio and about 371 crore for the NPA in terms of the security receipts. Recovery rate is good. It is at 14% for the return of portfolio, 16% for the sale to ARC in terms of NPAs. Recovery rate otherwise in MFI portfolio is largely in single digit, anywhere between 4% to 9%. So this is a good rate that they have got on their stress assets that they intend to sell. Back to you.
Okay, thanks a lot for that, Abhishek. Well, there were a couple of large trades that took place yesterday, both on Divyani and Greenlam. Vivek joins us to run us through details on that front. Morning, Vivek.
Well, good morning. So keep an eye out on both of these names. Devyani International yesterday saw a large block deal happen. So one of the entities, Temasek, that held almost 5.88% stake in the company, sold half of its stake yesterday. So 2.9% equity is what they've sold. Now the buyer, one of the large buyers was Franklin Templeton. The worrying factor is the fact that they continue to hold around 2.9% stake. And, the street will now watch out for what exactly they intend to do with that particular remainder stake. Greenlam, very interesting block deal happened. An entity called Smithy Holding and Trading Company sold 2.6% out of the total 4.9% stake that it held in the company. Now, this particular entity actually is the family office of Asian Paints co-promoter, Jalaj Dani. Again, they continue to have some stake, and one of the large buyers was Asiana Fund, picking up almost 33.4 lakh shares in this particular company.
Okay, got that, Vivek. Thanks very much for the updates there on those two blocks. Sonal is joining in. She has some more stocks and news with her. Sonal, which ones?
Well, 4 stocks on my radar. Let me start with IOC because the company has received approval to carry on pre-project activities. This is for a feasibility report for their petrochemical plant in Odisha, that is at Paradeep. And the total project cost is at 61,077 crore rupees. And it is a big capex that the company has planned. So it is an important step here. Zydus Life has received final approval for tofacitinib tablets. That is the final approval for 5 milligrams. And they have received tentative approval for the same drug for 10 milligram variant, so that stock is in focus as well. HG Infra is the L1 bid winner by North Central Railway for a project which is worth 655 crore rupees. This will be constructed over a period of 36 months. And lastly, also watching out for Tata Power because an arm or a subsidiary of the company has received an order 200 megawatt solar PV project in Solapur, Maharashtra. So that stock on our radar today as well.
Okay, got that, Sonal. Thanks very much for the updates there. So those are the stocks in news today. Let's quickly recap our list. The ones that have positive news flow around them are Hindustan Zinc, Vedanta, Tata Motors, Bandhan Bank, Indian Oil, Zydus Life Sciences, Tata Power and HG Infra Engineering. The stocks which have negative news around them are Devyani International and Greenlam Industries because of those two block trades.
All right, we'll take a quick break here. We'll come back with Siddharth Khemka of Motilal Oswal Financial Services, who will join in for some fundamental stock talk. Later, David Lennox, analyst at Fat Profits, will join in to put the focus on oil prices. Stay tuned for those conversations.
Welcome back. Hope you're having a good morning. Well, we ran you through the entire trade setup as well as stocks you need to focus on. But let's focus on the commodity space. Manisha Gupta joins us to tell us what's going on gold, industrial metals, as well as on crude. Morning, Manisha.
Thank you for that, Nigel. Well, one thing that every asset class is waiting for is the U.S. Fed action and what really could come out of that. So we clearly have moved on from the banking crisis where the U.S. Fed has offered daily currency swaps with various other central banks. And now this focus has shifted to the Fed action, and we will hear that announcement come in today. So ahead of that, you have seen some buying come back in case of the crude oil prices. We did see a 15-month close on to this one in this week itself, but we have seen last 2 days see constant buying here. The Goldman Sachs, while it has downgraded the 12-month Brent outlook from $100 to $94, the markets still are watching out for Chinese economic data because the maximum demand growth for this year will come in from China. In the other side, industrial metals are trading on the higher side of the range. The retreat in the dollar and the hope of strong demand from China has been supportive here as well. And then you have seen a couple of important economic data come in on the positive side. The U.S. home sales after 12 months of slide have seen some strength. The Chinese house completion has gained up by 8% after slide by 15% in the previous year. So we have seen the construction and infrastructure demand come back, and that has been supportive for metals. So whether it's copper or aluminum, we are trading in the positive for this. But after the investors have turned into riskier assets, there is definitely some profit taking that you've seen in precious metals. So the gold prices slipped 2% overnight. We've seen silver prices decline as well. And a lot of longs that were being created, we are looking at profit taking coming in for gold and silver. So after hitting a $2,000 of a high in case of gold, we are trading just at about 1940 right now. A very sharp comeback in case of gold and silver both.
Okay, got that. Manisha, thanks very much for that wrap. Actually, I want to discuss this a little further, so we have a guest joining in as well. David Lennox, analyst at Fat Profits, is with us. David, thank you for joining in. So it's a little hard to talk about, pure market dynamics, right? It's all about banks blowing up and what the Fed will do. But I mean, help us look at the market X of some of these issues, because the fears, at least for now, seem to be subsiding. We had a very volatile move in oil prices over the last week, 10 days. Where do you think perhaps things can settle?
Look, certainly, yeah, we've seen a volatile markets as we've seen prices not only in the oil market but in the gold market as well reacting to either positive or negative news and not reacting in a minor way. We've actually seen some major falls across both those asset classes. We did see Russia come out and indicate that it's not going to do anything in terms of at this point in time to lift production. So that certainly has put somewhat of a firmer footing under the oil price, and we did see on that news that reaction coming through on the positive side. Look, overall, one would have to suggest that you've still got to look at what's happening in China. As that country continues to open up, we will see further demand coming out of there. That demand at this point in time is probably not quite fully covered by supply, and that we believe will certainly continue to support the oil price. However, in the very, very short term, we still have the concerns around a recession, and of course we're watching what the Federal Reserve, as Manisha just mentioned, what the Federal Reserve will do in terms of their action regarding interest rates in that country. So look, overall, there is still probably a downside premise to the oil price, with the fear of that global recession still hanging there. But of course, we're well aware that the Federal Reserve may pause come this April, and if that's the case, that might reverse that feeling fairly quickly. So overall, expect volatility, perhaps with a little more of a downside to it as well.
I mean, David, just coming back to you, let's put up the stock of Reliance Industries. I mean, when you talk about oil and gas, the one stock which matters here is RIL, and RIL went up 3% yesterday. Now in the margin, it's a little mixed. I mean, there's no clear answer in terms of whether the stock benefits when prices are high, underlying oil prices are high or low, because they've got the refining business and they've got an exploration business as well. Although the exploration business is smaller, much smaller as compared to the refining side of things. But that's the one to watch. Oil marketing companies, by the way, have also done well. For them, it's, of course, clearly positive when oil prices go south and not higher. David, in the physical market, there is no tightness, right? I mean, the oil markets.
Look, one would have to suggest that at the moment, yes, and we've seen this because oil is well off its highs that we saw last year. So that would suggest that there is certainly physical supply available. It has been the destruction of demand outlooks that have really caused the oil price to drift lower. Not so much what's actually happening with physical demand. If you have a look at China, its demand is growing now that the country's reopening. Supply is adequate, and we saw that when Russia came out and said that they weren't going to do anything further with their production, and that sort of caused the price to rise, but not significantly. So one would have to suggest that we're probably at a point in the markets now where supply and balance are somewhat in balance, and we do need to see either a positive or negative event that will push it in either direction. And at this point in time, as I've suggested, we do believe that there is still that downside risk with recession still hanging over the global economy.
David, we're looking for a couple of levels then. If you could help us out with that. There's a downside risk. Where is it headed? And where do you see, in case things go right and we don't have that harsh recession, then where is oil headed? Because oil is very, very important from an Indian market perspective.
Certainly to the downside, we don't think it's going to probably go much below $70 on the Brent side of things. We do believe that, and we saw those talks coming between Russia and the Saudis, or supposed talks, and then a reaction from Russia. We do believe at those sorts of levels we will see OPEC and OPEC members in Russia certainly discussing ways in which to lift the oil price. So that we believe is probably the floor. If we see it go below that, those meetings will definitely occur. To the upside, that's really the difficult one. We've seen markets trying to perhaps push back through to 75 on the news that we're going to perhaps see the Federal Reserve pause its April rate hikes. If that's the case, then we may see it start to move back through that 75 level, but we will really need to see that fear of a global recession going away, and we will need to really start seeing some good figures coming out of China in terms of demand. If that's the case, you could expect it to push through to $80, but at this point in time, we think somewhere between probably $75 to $80 is where it may rest in the nearer term.
Okay, all right, David, we will wrap it up on that note for today. Thank you very much for joining in and giving us some sense on where the market perhaps could head. That's a word on oil. By the way, folks, are you looking at those flashes on our screens? Pretty interesting. And this is coming in from, a U.S. government report saying crypto assets have no intrinsic value, artificial scarcity to support prices. That's a lot of hard talk. I wonder how the crypto market's going to react to that.
They got in touch with Charlie Munger, maybe. I mean, if they did, the report would be more entertaining. They'd use words which... But that's crypto for you, and interesting. Siddharth Khemka is with us, Head of Retail Research at Motilal Oswal Financial Services. Siddharth, good to have you with us here. Thank you very much for your time. Now, let's start with, we were just discussing oil, and let's just start with your view on Reliance Industries, which went up 3% yesterday. In this current episode of sell-off, which began the Wednesday before last, Reliance has been one of the big losers, at least had been till yesterday's rally. What's your view here?
Yeah, very good morning, Prashant, and to all the panel. And first of all, I would like to wish all the viewers a very happy Gudi Padwa and festive seasons. So I think if you look at Reliance, if you look at the quarterly results for the past few quarters, I think the core business, the O2C, the oil to chemical business, is something that has been driving the performance. While the erstwhile high growth businesses, that is of the telecom, that is Reliance Jio, and the retail business, somewhere that saw some kind of softness in terms of growth because of we saw in the retail business across the board footfalls coming off after the festive season. Consumption demand kind of took a backseat in the last quarter, and that kind of impacted the growth for the retail business. If you look at the telecom company business, that I think had been getting kind of slower growth because of the penetration and no increase in tariffs. But now I think with the strong rollout of 5G, they are expected to roll out 5G pan-India by December in order to take head-on with Airtel, which is also doing a faster rollout of 5G across the states, and the newer plans that would drive growth in the telecom business. Also in the retail business, we believe that growth would pick up with the aggressive expansion that they are doing, and also the revival in the consumption demand later half of the next year. So that should help these two businesses. Now coming to the core question of the core business, that is where the pressure is coming because of the fall in crude oil prices and the Singapore GRMs, which have come off from their highs, leading to pressure in the overall stock of Reliance. But I think that is now somewhere stabilized. Things would improve from here on. Going forward, we expect a strong growth in the core oil to chemicals business that should drive the overall performance. Valuations have definitely come off with about 20% correction. I think it's a good buy at current levels. We continue to have a very positive outlook on Reliance from a 1 year perspective. We currently have a target price of about 2,800 on Reliance.
All right. Hi, Siddharth. Morning. What about Vedanta and Hindustan Zinc? Street is always confused what's going to happen next with regard to the promoter entity. Now they've gone and paid a big dividend, from Hindustan Zinc, which flows to Vedanta and then flows to Vedanta Resources as well. How do you approach these stocks? Valuation-wise, Vedanta Limited is very, very attractively priced. The problem is the uncertainty. So your approach to both these two stocks?
Yeah, very good morning, Nigel. I think it's a very pertinent question. Again, looking at the high dividends that Vedanta has been announcing on back of the cash flows that it is getting from Hindustan Zinc, and B, on its own core business where we saw the upcycle. However, now the commodity cycle is on a down trick. We saw the numbers for Q3 where the PAT came off significantly on a Y-on-Y basis, as well as much below our expectation. The core question is that someone wants to play the dividend that the company is going to announce, then it makes a sense at current levels. If you look at the holdco, the debt which is due for repayment or refinancing in the next 6 months, based on our estimates, is about $2.5 billion. And of which in Q4 of FY23 itself, $550 million of repayment and refinancing is due at the holdco level, which is a Vedanta promoter entity. So definitely a bulk of this dividend that Vedanta would be receiving from Hindustan Zinc will flow back to the shareholders as dividend, be it the Vedanta promoter, be it government and minority shareholders like us. So that is something positive. Already in FY23, the company has announced a dividend of 81 rupees, and to add to it, there could be another 18 to 20 rupees of dividend that could flow from on back of this. So if you look, if someone wants to play this, then I think it's a short-term play. Apart from that, we believe that the earnings would remain under pressure. Although valuations have come off, we still believe that it is kind of pricing in the current environment, which is an uncertain global environment with the recession looming in at the US, Europe, which is a key consumer countries. China reopening had helped in between, but I think that will not be a strong factor going forward for commodities globally. And with LME prices coming off, I think at best we have a neutral rating on Vedanta, but I think bearing the near-term dividend play, we don't see a huge upside to Vedanta.
Okay. All right. So that request you to stay with us. For the time being, we'll slip into a short break. Up next, we'll get our technical experts, Mitesh as well as Sudarshan will be back with us for some technical trades.
All right, welcome back. 9 minutes to go for the pre-open session. The SGX is indicating a 35-point higher start. Anuj is here in the studio to tell us what he's making of things. Anuj, hi, morning.
Morning, Prashant and Surbhi and Nigel. Well, for starters, to all our viewers, a very happy Gudi Padwa, Ugadi and Navaratri. It's the start of Hindu New Year. So wishing everyone a very happy day and a very happy year. And hopefully this would be a great year for all of you. Now, talking about the markets, one of the most important days, right, the D-Day for markets because of what the Fed would do and what the commentary would be. But most markets are trading with hope, especially after what Janet Yellen had to say yesterday and ahead of that Fed meet. And even the Indian market yesterday sustained a rally. I think today's big trade might come on the Nifty IT, because if you look at what's happened over the last 7 days, Nasdaq is up 6.5% and Nifty IT is down 5%. The dichotomy has happened because while on the Nasdaq you're pricing in a lower terminal rate, and which is what the bond market is also pricing in. But back home on Indian IT, you're worried about what's happening with banking. But with comments from Janet Yellen yesterday and the kind of rally that we have seen in banks yesterday in the US, my sense is today you could see a bit of a rally in IT stocks. Now for the Nifty, it's in critical zone 17,145 to 17,225. That is the next big resistance, and strong shorts will have to cover if you start to cross 17,225. Till then, I think the FI shorts might actually see some more addition. Above 17,225, there's no major resistance till 17,500. And on downside, the first support is at 17,016. And the big support, of course, like we've been mentioning ad nauseum, on the channel level of 16,750 to 16,800. The Bank Nifty has led the recovery over the last couple of days, and especially ICICI Bank and Axis Bank have had very strong follow-through. and the close has been quite strong, and the texture buy on dips for Bank Nifty, but it faces some big resistance now between 40,000 and 4,200. So as I said, my sense is today you might see actually a bit of a reverse play with IT stocks leading the charge. Also, post 3 p.m. it will be interesting to see what traders do, because you'll have to prepare for a gap up or gap down tomorrow, depending on what the Fed does.
All right. Thanks very much, Anuj, for joining in with that perspective. So we're all watching, waiting and see what the Fed delivers and then kind of take it from there. With that, let's bring in our technical experts to talk about how we can look at the trade setup this morning. Mitesh Thakkar as well as Sudarshan Sukhani both in the house. Gentlemen, good morning and thank you for joining in. So, Mitesh, let me start with you first. I mean, we had a first decent positive close yesterday. It wasn't a sell every rally kind of a market. How would you approach trade this morning? You're on mute, Mitesh.
Now is audible?
Yes, we can hear you now.
Okay. So, good morning. Wish you and the entire team at CNBC and all the viewers a very happy Gudi Padwa New Year. I think, we have been calling for some kind of a bounce back, saying that 16,800 might not break, and we might do some base building between 16,800 and 17,150. Eventually, recording a bounce back to possibly 17,280, 300 zone. So I think that movement is still on. Today, I think we'll open closer to about 17,150 on the Nifty spot. In case we see follow through post the gap up or the mild gap up opening, then I think longs can be taken with stop at about 17,120. And I think, 17,300 will be a short-term trading target. I'm not looking at a big rally or a big up move starting, but this looks like a reversal on the intraday charts, and therefore next 2-3 days could be mildly positively biased. The only worry is that in case you fail at 17,150, we might have one and a half more days spent back. I mean, we'll do that consolidation again for 1 and a half more days, and then eventually attempt to go back.
Gentlemen, good morning. Sudarshan, what about you? How are you looking at things?
Yeah, good morning. First, my greetings on the first day of Navratra to all viewers. Now, the Nifty was a buying opportunity yesterday, and I suggested we go long. That trade continues. Today also, the Nifty had a narrow range day. It's likely to break on the upside. So there is a long position that is justified. You can buy it on in the morning, or you can buy it on a minor dip. Both are okay. But the problem is the decision, the Fed is going to do something in the evening when we will be closed. So personally, I always stay out of the markets during big news events. So it is for the trader to decide whether they want to carry this position tomorrow or keep it intraday. But the trade is to be long, and that applies to the Bank Nifty, which is outperforming and on the verge of a breakout. The same problem of an overnight exposure comes there. You have to manage that on your own, but I would be long.
All right, got that. Gentlemen, just stay on. We'll take a very quick break. We'll come back and get a couple of trading ideas going as well in terms of specific stuff. We'll also have the pre-opening rates. So back in just a moment. Also, a conversation coming up with Abhinesh Roy of Nuvama Institutional Equities. We'll talk about how to focus on the FMCG sector given all the cues.